Welcome to the Daily Drawdown, where AI capacity, capital, and market concentration are driving the tape. The market keeps sending the same message: if it touches AI hardware, capital finds it. Even war headlines, rising long rates, and crowding risks haven't displaced the main trade yet. Chip stocks led again, and the leadership was narrow but powerful. Investors are treating AI hardware as the clearest growth engine in the market, with hyperscaler spending flowing straight into memory, tools, optics, and component suppliers like Micron, KLA, Applied Materials, and Lumentum. The practical point is simple: the AI buildout is no longer an abstract software story. It's a supply chain story. And right now, the suppliers with scarce capacity still have pricing power. Memory is the tightest part of that chain. Prices are surging, gross margins for producers are being discussed in the mid-80s to roughly 90% range, and buyers are locking in 5-year supply contracts with penalties because they don't trust spot availability. Coverage suggests meaningful relief may not arrive until late 2027, which forces both cloud buyers and suppliers into multi-year planning now. That helps explain Micron's plan to invest more than $250 billion in U.S. semiconductor manufacturing through 2035. For the market, that is bullish, not just for Micron's domestic footprint, but for the upstream equipment names that benefit when capacity actually gets built. Meta plans to put its custom AI accelerators into production by September and is working with Broadcom on multiple generations of in-house silicon. That matters because hyperscalers are trying to reduce dependence on outside GPUs and keep more of the economics of the AI stack for themselves. The important watch item is whether these custom chips meaningfully absorb workload from merchant suppliers or whether overall demand is growing fast enough that both models win for a while. Two crosscurrents stood out inside semis. First, NVIDIA's forward multiple has compressed to about 18 times, reportedly its cheapest level since 2019, even though it's still the central platform name in AI compute. The bull case is that NVIDIA still has a logistics and supply chain moat that looks more like a systems business than a chip vendor story. Second, SK Hynix's US ADR deal was reportedly more than 7 times oversubscribed, with expectations for a 10 to 15% premium to Seoul shares because pure HBM exposure is scarce and hard to arbitrage cleanly. Put those together, and the message is that capital still wants AI memory and compute exposure, but it's getting more selective about how much premium it's willing to pay. On the model side, OpenAI launched ChatGPT 5.6 and says it's about 54% more token efficient on coding and agent tasks. That matters because efficiency is now a commercial feature. If compute is the bottleneck, better output per token directly improves margins and pricing flexibility. At the same time, OpenAI's consumer LLM share reportedly fell from around 60% to 46% after fresh launches from Google, Anthropic, SpaceX, and lower-cost players like DeepSeek. Competition is broadening on price, speed, and specialized performance, so model leaders now have to defend both quality and unit economics. Anthropic shows the pressure from the other side. Reported compute spend around $1.25 billion per month is a reminder that market share without durable economics can become very expensive, very fast. The next issue is funding. Major tech and AI companies are leaning on debt markets to finance CapEx, with Amazon's $25 billion bond sale showing there is still deep demand for high-grade AI-linked issuance. But financing is getting more expensive. The 30-year Treasury yield, around 5.05%, raises the hurdle rate for giant data center, fab, and power projects. Even so, lease economics for reliable AI capacity remain extreme, which tells you investors still view scarce power and compute access as premium assets. That feeds directly into site selection. Infrastructure rankings favored Illinois for reliable power and water and Virginia for density, while water and grid constraints are reshuffling other states. Ohio still ranks well for business overall, but even their incentive policy is tightening because the grid matters more once every AI project starts looking like an industrial load. Where this goes next is straightforward: more utility deals, more gas and LNG support, and more permitting fights as companies try to secure power before they secure customers. In the Middle East, U.S. strikes reportedly hit about 90 Iranian targets after the ceasefire was declared over, and there were missile alerts in Bahrain and Qatar. Markets largely shrugged. Crude held around the low to mid 70s in WTI terms and the upper 70s in Brent after an initial dip. The more actionable energy story was downstream tightness. Crack spreads widened to about $57 a barrel, the highest since June 2022, while U.S. refineries are running above 95% utilization. Strait of Hormuz tanker traffic is lower, Russian diesel exports have fallen sharply, and Chinese export restrictions have tightened product availability. If that continues, refiners remain the cleaner expression than broad oil exposure. On the consumer side, PepsiCo is dealing with two pressures at once: inflation fatigue and changing eating behavior tied to GLP-1 weight loss drugs. Internationally, growth held up, but North American snack sales slipped. So the response is more portion-controlled products, more protein and fiber, and more focus on functional hydration and multi-pack formats. Separately, restaurants and consumer platforms are pushing applied AI for efficiency rather than hype. Chains like Starbucks are building in-house tools to cut labor and software costs, while Match is using AI to centralize marketing, improve customer acquisition, and run localized pricing tests. The practical takeaway is that outside the chip complex, AI adoption is increasingly about margin improvement and operating leverage. Two market structure issues are worth keeping in view. The Fed launched 7 task forces packed with former central bankers, academics, and industry figures to study reforms, including whether communication should be higher quality and less frequent. That debate matters because forward guidance has become a market input in its own right, and changes to cadence or format could alter how rates volatility transmits into risk assets. At the same time, market dispersion is at record highs, concentration in megacaps remains extreme, and single-stock leveraged ETFs and large options positions are adding fuel to momentum reversals. So even while the AI trade keeps working, the tape is getting structurally more fragile underneath. One final parallel to AI, defense tech is also attracting bipartisan spending and investor excitement, but scaling hardware is expensive and operationally hard. CapEx jumps of 5 to 8 times are a reminder that big addressable markets do not protect companies from execution risk or valuation excess. That same warning applies across the current build-out cycle. The main trend is still intact. Scarce AI capacity is absorbing capital faster than macro risk can deflect it. The watch list from here is memory supply, power access, financing costs, and whether concentration finally starts to bite. That's it for the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.